it's interesting to think about how it could blend with income sharing agreements, like you're saying, especially as like, gig economy and the life and the lines between personal and work kind of get blurred as well.
Mhm.
And then, it makes a lot of sense what you're saying about the operational piece too, in terms of, just want to call that out because like 10, 20 years ago on the startup side as well, in addition on the financer side, a team of 4 people don't want to do their monthly financial statements to perfection in order to pay back those RBF payments, etc. So yeah, that makes a ton of sense that like now the tech has finally caught up and made it easy enough to do that.
Yep.
Awesome. And then I guess how should, in your opinion, since you see a bunch of deals and you're in this every day, how should founders or executives think about like incorporating revenue-based financing into their capitalizations, strategy or their capital stack? How do they think about it in terms of like debt to equity to typical bank finance, etc.? Any guidance you have there?
Since we launched June of 2018, which is when we went live with our platform, we've spoken to about 1,000 founders that we actually have information that recorded on. And most of the conversations lie around how do I think about accessing capital options, because no one's an expert in capital raising, right? Most of these founders or entrepreneurs, they're great at their specific niche, whether it's developing software or HR or leadership or marketing, sales, like these different qualities that are very predictive of a company's future success. But when it comes to the laborious, accounting or financial side of the business, very few entrepreneurs are extremely savvy in that area. So there is a conversation around education and how you should think about designing your capital stack such that it provides you with the financing that you need to grow, yet also does not burden you with a high cash flow restraint or constraint on a monthly basis, as well as cost of capital overall. So when I think about how you should design your capital stack, you're almost suboptimal if you're focused on one type of financing product. So if you're only using credit cards, that's a problem. If you're only using equity, that's a problem. What you should be doing is trying to determine your capital requirements and specifically your cash flow requirements over a short term, a medium term, and a long term basis, and then try and find the financing options that are cheapest for those time horizons, and then work towards ensuring that you have that capital or financing ready for you for when you need it and you can access it from those instruments. And so for us, the way that we design revenue-based financing for our entrepreneurs, it's done in such a way that because it's linked to your monthly revenue, if you're growing your monthly revenue, typically you would need a higher proportional cash flow requirement. And so we give entrepreneurs the option to come back to us and refinance at their new current monthly revenue numbers to be able to unlock more and more capital over time. So in a way, it allows you to minimize the design requirements of your capital stack, therefore allowing you to focus more on other parts of your business that are arguably more important. However, I do recommend that if, let's say, you don't have revenue-based financing and you're not able to access it, that you find a way to get a combination of debt and equity, because more debt is better. It's obviously a lower cost of capital. Equity, it may provide you with additional benefits that debt does not, such as the network effect of a venture fund or advisement and other perks that come around with the status of raising venture capital. However, if I were to start a company today, I would almost certainly not raise money from equity investors for a very long period of time, as long as possible. If you are dead set on your company being successful, you should try your best to use your own personal leverage, whether that's through a personal guarantee or through your own capital, to be able to get that company to a later stage. And we see that a lot because there's entrepreneurs that will come to us that are second and third time founders, and the one regret that they have is that they raised too much money too quickly.
Yep. I just saw the same thing. in a survey.
When it comes, yeah, sorry. When it comes to an IPO, about 15% is owned by the founders of the company by the time that happens. And so 85% is, to all your stakeholders and your partners. There's a couple of IPOs that happened where the founders did it right. Atlassian is one of them. The company behind Bitbucket and Jira.
Yep.
However, those are exceptions. There's this mentality that we have to just continuously raise every 12 to 24 months in increasingly larger sizes and move throughout the pre-seed, seed, series A, B, C, D, and all the way up to an IPO. But that venture model, I think, is a little bit inherently flawed, and we're starting to see that flush out with WeWork and a couple of the other, public disasters, we'll call them, that we've seen in the last couple of years. It's always been a game of increased revenue and growth over profitability. And I don't agree necessarily with that model. I think there's got to be kind of a focus back on what really matters in businesses, which is maximizing shareholder value and increasing profitability.
Yeah, not to mention all the time wasted by founders doing those fundraisers for 6 months at a time sometimes.
Yeah, absolutely.
Like everyone who's running a business knows how valuable your time is. If you're burning half of it fundraising, why not go with a better model like you were saying?
Yeah.
Awesome. And then I'm curious. So once you execute a revenue-based financing term sheet or an agreement, I know some RBF shops offer or include warrants and other mechanisms in their term sheets. As a financer, can you talk about kind of why that is or the reasoning behind it?
Yeah. So for us, there's two reasons primarily. One is that your upside is capped, generally speaking, in a revenue-based financing instrument.
As a financer, you're saying?
As a financer, yeah. And in order to kind of break that cap and get more venture-like returns for the level of risk you're taking on, you will typically add in a warrant, which is generally pretty small. And there's an analog between revenue-based financing warrants and venture debt, right? Because in venture debt, you're taking out secured debt against the company. It's a small interest rate, typically sub 20%, and then eventually there'll be a conversion into equity, so that you still get that nonlinear return.
Yep.
And so revenue-based financiers are trying to emulate that by adding warrants into the agreements. So there's that element of the uncapped upside that it gives you, but it also gives you an opportunity for control in the future. And so if you have a company that you have helped finance throughout its entire maturation cycle, and let's say they're ready to do an IPO, you want to be in a position where you can have a controlling stake, even if small, as a link to management to help with advisement at a minimum. And so there's that aspect of it where you want to have a little bit more involvement in the business and not be as hands-off as a debtor. And then there's the unlinked upside. Other than that, I'm not sure if there's any particular benefits from the business's standpoint to giving away a warrant, aside from being able to negotiate a better position for terms. So what we've noticed that in some cases, there's founders that are willing to give up more of a warrant and to reduce their monthly royalty payments.
Interesting.
And that's a very reasonable expectation, because in some businesses, obviously the gross margins are a little bit thinner. You don't want to put yourself in a situation where cash flow insolvency could happen. So we'd be comfortable, and I know a lot of other revenue-based financiers are comfortable with kind of delaying the return as a result of including the warrant.
That's interesting. I mean, then it really starts to be a hybrid between the two, between debt and equity. I mean, it literally is a hybrid, I guess, in terms of how those term sheets are designed. Awesome. And then kind of on the flip side, are there any, I guess, behaviors or things happening in the market that you either disagree with or just generally think need to be improved over time? So maybe it's because, like you were saying, revenue-based financing is still not a super mature industry. There's still a lot of education to be done. Are there any kind of industry practices that you think we could just overall as a community improve?
So there's certain financiers out there that will focus on very short-term revenue-based financing instruments. and they tend to have really high rates or cost of capital. And the founders don't always realize that, because they just see like, oh, this is like a royalty percentage, and here's kind of like a buyout amount or a repayment cap.
Mm-hmm.
And if they don't actually do the calculations on determining what the effective rate would be for that cost of capital, they can end up paying a lot of money if they grow really quickly. Yeah. And so the one thing, it's obviously more about education than anything else, but there's certain financiers out there that don't supply the level of information that may be needed prior to you applying, or prior to you essentially getting a term sheet, to be able to fully comprehend what the cost could be. So industry to supply calculators and information and education and testimonials from different people that have taken revenue-based financing or are offering it, so that entrepreneurs can make literally the best informed decision that they can. So from an education standpoint, there could be some work done. And then from the financiers themselves, I wish some would focus a little bit more on explaining why the instruments are so costly if you're growing quickly, and not just offer kind of what would be considered a startup payday loan.
Yeah. Yeah, that makes a ton of sense. And then kind of just to wrap things up and put a bow on all of this, when is an ideal, or what is an ideal scenario, or who's an ideal founder to reach out to Corl? And if you want to throw in kind of like why Corl is a great partner for those founders, it'd be really helpful for people to know when exactly to reach out to you.
Yeah, so for us, we look at companies that are at least 10,000 in monthly revenue. Typically, they'll have at least 6 months of a revenue history. They don't necessarily have to be operating for years or have many assets on their balance sheet. We focus on profitability and or path to profitability. So if you're growing your revenue, to at least 2% every month, preferably a lot higher, and you need to unlock capital for a certain growth reason. So that could be sales, marketing, hiring, and you have a clear path to how you're going to grow the company. That's when we want to start talking to you. So this is not necessarily pre-revenue capital. This is not capital that would be if you're, 5 million in annual revenue, because there's other options that I would argue are cheaper for you. Mm-hmm. But if you're in that, couple 100,000 to 5 million in annual revenue and growing pretty quickly, that's when you would want to talk to us. And then also, like, if you cannot get financing from us, because the reality is that not everyone does, then like we're happy to be in a position where we can refer them out to partners like Bootstrap, where there's a list of other alternatives out there.
Yeah, awesome. Excellent. Well, yeah, any final thoughts you want to share with Corl, where you guys are headed, or anything else before we wrap up?
No, I'm just excited about 2020. I mean, it's a year that's going to be, I think, really formative for the space.
Yeah.
We're going to start to see a lot more, even venture funds, because I've been having some private conversations with some very large sovereign wealth funds and venture funds that are interested in this space. And so I would expect to see a couple of venture capital VC funds start to pop up. I'd start to see more competition in the space, which is ultimately great for entrepreneurs. So I'm looking forward to that.
Yeah, awesome. Well, thanks for taking the time to chat. I know you got some travel later on today, so we'll let you get to it. And yeah, just really appreciate it. And then I'll of course drop Corl's information in the description and everything, so people can find you guys directly.
Great. Yeah, I appreciate this, Thomas. Thanks a lot.
Yeah, thank you, Derek.